All the audience should listen carefully. So, this is the most actionable advice in this entire conversation we had so far. When it comes to RSUs, this is one area where RNOR gives you zero protection.
Most NRIs think moving their money to India is just a bank transfer, but doing it at the wrong time can cost you a fortune. In this part 2, Megha and I are breaking down the mistakes that actually cost people real money. Like one NRI we know who lost 30 lakhs simply because they didn't know about the specific 2-year tax window. We are going to show you how to move your money without the US or India taking half of it, and which bank accounts you need to move before you board that flight to India. This is the stuff nobody tells you until it's too late. So now let's get into it.
Hi, Megha. Welcome to the show. Let's say if someone withdraws from the 401k after moving to India, where is it taxed in the US, India, or both?
So, see again, all the India and US related stuff, it does not have one single answer. So, in this case, the withdrawal, it depends on how you withdraw. Whether you are doing it a periodic payment or whether you're doing a lump sum withdrawal, right? Because the India US tax treaty treats it differently. If it's periodic payments, let's say monthly or quarterly, under Article 20 of the India US DJAA, regular pension type payments are taxed only in your country of residence, which is India, once you move, right? Whereas when you come to lump sum withdrawal, if you want to take a one time withdrawal, the DTAA article changes to Article 23, which covers other income. And that article says both countries can tax it, right? So the US withholds 30% upfront. That's their rule. India also taxes it as other income based on the slab rate. So obviously in India, you can claim a foreign tax credit for whatever you have paid in the US already and file Form 67 to avoid the double tax. But let's say if your effective US tax rate is lower, right? Let's say in US you have paid only 15% and in India your slab is coming to 30%, then you'll have to pay taxes, right? Eventually in India. So people need to plan it properly. Periodic payments would be better than lump sum payments in a nutshell.
Got it.
Yeah.
So there is an early 10% penalty, right? When we remove money from 401k. So does that apply when we are living in India as well? Like if we
Yes,
remove
the
when we are in India?
so yes, actually, the penalty is a US rule attached to the account, not where you live. Irrespective of wherever you're living, if you withdraw it before 59 and a half years, you pay the 10% penalty. But India doesn't recognize or this separately, right? From India's perspective, it's simply a cost that reduces your net proceeds. So that does not enter the Indian tax calculation. But US point of view, anywhere you're there, the 10% penalty will still be applicable.
So now with so much confusion, is there a smart way to plan 401k or IRA withdrawals during the RNOR status?
Okay, so I think all the audience should listen carefully. So, this is the most actionable advice in this entire conversation we had so far, right? First, confirm exactly how many RNOR years you have, right? Typically, it is two. Sometimes, if you are able to plan better, it can be three. During your RNOR, 401k withdrawals are not taxed in India. So, your only tax variable is your US tax bracket, right? So, spread withdrawals across your RNOR years to, to stay in the 12 or 22% US tax bracket, which is generally lower than if you do a full withdrawal. So, basically, simple logic goes use the RNOR status, try to see where it is not taxable in India, do partial withdrawals in US where the tax rate is comparatively lower than what you normally have. That's how you'll be able to save, right? Set up periodic payments, not lump sum, as we discussed earlier about DTAA. And then consider doing Roth conversions during these years, right? Convert a portion of traditional IRA to Roth each year. You'll pay US income tax on the conversion, but not Indian tax because it's a foreign sourced income for RNOR. The cleanest way to plan is this only. And if you are in your last RNOR year, right, don't wait, pull forward as much as you sensibly can, because once you cross that ROR status, right, once you become a resident, same withdrawal can cost you heavily both in India and in US.
Got it. I think one advice is that please don't try to do all of this on your own. Just have a CA combination to figure out all these things. Otherwise, you'll lose a lot of money on tax.
Yes, I think a lot of people try to save, right? With AI coming in, a lot of people say, yeah, we are taking help from ChatGPT or Claude or whatever the other apps. But I think please reach out to professionals, right, for advice, and don't try to do it on your own. For just to save maybe $1,000 or $5,000, you will be spending a lot more in penalties and taxes if something goes wrong.
Hey, are you guys still listening? Then hit that subscribe button. It tells me you're finding this useful and helps more people discover conversations like this.
So if someone sells they have their US stocks, right, after becoming an Indian resident, how are capital gains taxed in India and the US?
See, on US side, generally the non-resident Indians selling US stocks don't pay US capital gains under the US domestic law. Obviously, the exceptional is the real estate. Real estate rules in US are totally different, right? But dividends you receive on those stocks along the way are typically withheld at 25% under the India-US treaty. On the India side, if you are a fully ROR resident, but resident and ordinary resident, the capital gain rule is if you are holding it more than 24 months, long-term capital gains taxed at 12.5% flat. No 1.2 lakh, 1.25 lakh exemption is not available because that exemption is purely for the Indian listed stocks, not for the US listed stocks. And if you hold it for less than 24 months, short-term capital gain, it will be taxed at slab rate. So one thing I think, see, the rates are simple. The Indian tax laws are now comparatively simpler. Government has, done a fair share of work there. But most important point people miss is your gain is calculated in rupees, not dollars. Right? The purchase price and sale price are both converted to INR using the RBI rates when you calculate here in India. So if the rupee has depreciated between when you have bought and when you sold, your INR denominated gain is higher than your dollar again. So this can significantly affect your actual tax. So I think that is also very important.
Oh, this I didn't know that it gets taxed after getting converted to Indian rupee.
Yeah, that's
That-
how it
that's
is
something.
calculated. Yeah.
Got it. So I think a lot of people have RSUs, right? Most of the software people have RSUs. So how should people think about RSUs when moving back? Like especially if your RSUs were granted in the US, but then they are vesting after moving to India.
See, as we discussed, RNOR, the transition period is very important, and it'll RNOR have a lot of advantages, right? But when it comes to RSUs, this is one area where RNOR gives you zero protection. Okay, and obviously this will be surprising to a lot of people. So RSU income at vesting is treated as salary, not as foreign income. And salary is taxed based on where you were working during the vesting period, not where you were living when it vests. So the income gets split. Let's say you got RSUs vested over 3 years. You work 2 years in the US and 1 year in India, right? The portion corresponding to the India year is taxable in India as salary income, regardless of whether you are NRI, RNOR, ROR. Indian income tax doesn't care. You have to pay tax if you have earned salary in India. But the US portion, the 2 years where you worked in US, is taxed by the US and shows up on your B form W2, right? If you are ROR, India also wants to tax that portion, what you have earned in the US. But in India, you can file Form 67, claim the foreign tax credit while filing the returns.
So coming to housing, right? Like I think a lot of people own homes as well in the US. So if someone is owning a home in US and they sell it after or before moving to India, what are the tax implications?
So I think 15% of the gross sale price is held back. They withheld that. They withhold that amount. So your actual tax is computed later on your US return, and the whatever excess is there, it is refunded to you back. India doesn't tax this at all if you are an NRI because it's a foreign income for them. Now, when you're selling it as RNOR, India still doesn't tax it because it's a foreign capital gain. RNOR exemption comes into picture. For US, it is the same form. The same mechanics goes. But when you become a fully resident, US, it is the same rules. India, they tax again because you're selling a property. It's capital gains, right? And then again, as I said earlier, in India, there is a form to claim foreign tax credit when you file your return for whatever taxes you've paid in US. You can deduct that in your income tax return. I think, and for people who also want to understand how the real estate, capital gain is calculated here in India. So if you bought the property before July 23rd, 2024, you got a choice. Either you pay 12.5% capital gain tax with no indexation or 20% with indexation. You can pick whichever is lower tax. If you bought the property after 23rd July 2024, it's 12.5% flat. No indexation option will be given in that case.
So, what foreign asset reporting does a returning Indian need to do in India or US bank accounts, right? Brokerage accounts, 401k, IRA, property, all of those things.
So, see, actually, this kicks in only when you are fully resident. For NRI, you need not disclose a lot of foreign asset. That schedule is not mandatory yet. For RNOR also, it's not mandatory. It's not required. Major points will be US bank accounts, your US brokerage accounts, 401k and IRA, RSUs and ESOPs, US property, right? And the penalty for non-disclosure is 10 lakh per asset per year under the Black Money Act. Regardless of whether any tax was due or not, this is the penalty for non-disclosure. Obviously, the government has given relief for smaller cases. They said that if your total foreign financial asset, excluding the property, is under 20 lakhs, this penalty will not apply. But still, the requirement for disclosure is still there. Interesting fact is, even after so much awareness about the non-disclosure penalty and it's important to disclose and all of that, CBDT here in India has identified over 25,000 taxpayers who didn't disclose foreign assets for financial year 24-25. And obviously, they are getting notices from the department. And the two most common errors I think they've observed is, one is using the wrong exchange rate while people are calculating. So the amounts are wrong. And second is confusion about the status. They are selecting the wrong residential status, ROR and RNOR.
Right.
So that is why I think we discussed in so much detail about the different status and how it will help people who are planning to return from the US to India.
So, let's do some rapid fire questions. The first one is, what is the biggest myth about moving money from US to India?
I think the biggest myth is that it will be taxed, right? People genuinely believe sending their own money to India triggers a tax, but it does not. Your own savings are not your income. The transfer is not a taxable event at all. What gets taxed is only after that money comes in, what are you doing it? What are you doing with it? If you're earning income from that money, obviously it is taxable once you are a resident.
Got it. So, what is one thing people should never do before talking to a CA or CPA?
So never do a full lump sum withdrawal of 401k or IRA because that will be taxed heavily. As per US taxes, India taxes, the 10% penalty, early withdrawal penalty, and you'll be losing a lot of money.
Got it. So, is it better to liquidate the US investments before moving or keep them?
See, keep them with a plan, right? If you're going to sell anyway, then plan it during, as I said, the RNOR period, plan it parts. It'll save you money, it'll save you taxes.
Hmm.
If you're going to keep it, you're going to keep it anyway. There's no question about it. Yeah.
Got it. And the last one, what is the most expensive mistake you have seen NRIs make?
I think, see, I have to think about it. Okay. So someone who had a 1 crore plus traditional IRA sitting untouched during their entire 2-year RNOR window. So they did not withdraw anything because they weren't aware of the rules. They've not contacted any professional. And the moment they became resident, they started withdrawing. So they paid heavy taxes, paid penalty in US, paid taxes in India. And that mistake, I think, costed them around 30 lakhs in total. So, yeah.
Yeah, that's a lot of money. Okay. So this was very useful, right? Thank you so much for coming on the show and doing this. I think most people think moving money from US to India is just like a bank transfer. But the bigger issue is the tax residency, the timing, the documentation, retirement accounts, and reporting, right? Finally. Also, for anyone watching, please don't treat this as tax advice. Use this as a starting point and speak to a qualified CA, CPA for your own situations. So yeah, thank you so much, Megha, for doing this.
If you found this conversation useful, you'll definitely enjoy the next one I've linked here. And if you want more real conversations like this, make sure you subscribe. I'm bringing one of these every week.